Hey, what's up, everybody? Today is Thursday, January 5th. Market was down today. Actually, had another one of these days where we got a much stronger than expected, some stronger than expected economic data in the ADP payrolls. And of course, what does that do every time? It triggers the monetarist zombies to sell. So they sold because, you know, here's the thing, folks. Like we are told to be afraid of Fed rate hikes. We must fear Fed rate hikes, even though I've been explaining that these rate hikes, I mean, functionally, they're a fiscal expansion. I mean, they're exactly the same thing functionally as the government sending out checks. And I remember, if you go back and you remember when that was happening during the pandemic, everybody saw that as very bullish. The market was going up. But now the government is sending out checks just in a different form, in the form of interest income transfers. And that's suddenly a terrible, horrible thing. So we're told to be afraid of rising interest rates and monetary policy. But we're also told to be afraid of a coming recession. So, like, which is it? Like, if there's a recession, why should we be afraid of monetary policy? And if monetary policy is literally the same thing as a fiscal expansion, sending out checks, which in the past, you know, has been a bullish thing, then why should we be afraid? So for me anyway, I mean, you know, I'm sure most people don't buy this line of thinking, but I see enormous contradictions in the behavior of investors right now. And if you know me, you know that I've said so many times in the past, you have to go against, you know, mass emotion. You have to go against these sort of contradictions, okay, the flaws in their analysis. And, you know, they're so big, I mean, you could drive a garbage truck through these holes. I mean, the holes in their analysis are enormous, and the contradictions are so enormous, and it's just like, you have to go against this. Now, I'm not saying every day is going to be easy. Look, I got to be honest with you. Like, today's market behavior, it did bother me, and I'll tell you why. Like, normally the pattern we have been seeing is that you get an early sell-off and then it rebounds near the close. It may not close positive, but a lot of the losses of the day are recovered. And that makes logical sense to me, because if we're in a situation of rising fiscal support, okay, let's go back to the swimming pool analogy, you know, the water's coming back up, okay? But there's that selling pressure, you know, is there. But it's going against a rising tide, all right? Like, if you're on the beach and you build like a sand castle or a sand wall, you know, right at the edge of where the tide comes up on the beach, that wall is going to last for a while, okay? Depending on how big you build it. But as the water advances onto the beach, it slowly gets eroded and it slowly gets eroded. So for me, that describes like what I expect to see right now in the daily behavior of the stock market. I expect to see, like, for example, today they sold the market down because of, you know, they were triggered by the stronger than expected. And by the way, let me just add, like, tomorrow, I think we're going to see another strong job report. You know, I've been showing you guys the spike in employment and withholding tax deposits, and for me that just has been a tip off, you know, telling us that a lot of people are employed and wages are going up. By the way, we saw the wages increase in the ADP report too. So I think they're going to sell it again tomorrow. And maybe one of the reasons why today we didn't get that bounce near the end of the day, I mean, they tried to bounce it, but not really. We ended kind of weak. Maybe it was because nobody wanted to buy or be long going into tomorrow's number. I can understand that. That's, again, one of these behavioral things, and it's just not going to last. So let me go back to this swimming pool analogy again, because I think I can clarify it with a little bit more, color, so to speak. Let's say you have a swimming pool, right? But the swimming pool is drained out. There's just a little bit of water at the bottom of the pool, but we're filling up the pool. We have our garden hose in there or whatever. We're filling up the pool. But inside the pool, we put a big, heavy object, like a car. Actually, a car will float for a certain period of time. So let's just say we put a car in there, windows closed, doors closed, everything. And the water is starting to come in. The water has to reach a certain level. In other words, like think about a ship. How does a ship, a big boat, a ship floats? It has to displace the same amount of water as its weight, okay? So the car is sitting in the bottom of the swimming pool, and let's say the car represents the monetarist zombie mentality, the selling pressure, okay? It's very strong right now. It's very strong right now. But it's going against a slowly rising tide, okay? That water in the swimming pool is coming up. Now the water is up to the level of the bottom of the wheels of the car. Car's not going to float, okay? The water comes up a little more. Now it comes up to, the bottom of the chassis, okay? Still not going to float. It's not enough. It comes up a little more. Now maybe it's, at the level of the lower edge of the doors. Starting to get maybe a little bit of buoyancy, but the car is probably still sitting there. The water has to come up higher. As the water rises, it reaches a level where the same amount of water is displaced as the weight of the car, and the car starts to lift. And as the water continues to rise, that car rises. Eventually the car sinks, but the car is just an example. If we could use something else, that's completely sealed, has, you know what I'm talking about anyway. So this is kind of like, for me, the way I see it right now. Like the selling pressure and the monetarist psychosis, that represents the car or the object, that heavy object in the pool. The pool water is definitely coming up. Like I'm giving you guys numbers every single day. I mean, actually, I have to tell you that right now, we're at the 10-day average of leading spending flows. Those are daily leading spending flows of the government. We're actually at where the peak was in mid-November at the when we had that quarterly interest payment. That's another reason why I'm kind of like disappointed in the market behavior, but it just goes to show you that the resistance, the size of that object in the pool, which represents the monetarist zombie psychosis, the size of that object is very, very large. We need a lot more water, but the water is coming, okay? We went through that drain, December 15th. And by the way, on that drain, what's today? It's January 5th. We still haven't replaced completely all the water. There's as of yesterday, there was like 1.5 billion still left that had to be replaced just to get us back to where we were on December 14th. All right, but now you have, a very intense zombie psychosis. I mean, the market was doing okay in the morning, and then that ADP report came out, and wham. I think you had some comments today from Fed officials, about, hey, we can't back off right now. We got to win this fight against inflation, blah, 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 this kind of garbage. And so that psychosis is still very large. I mean, but here's what I'm saying, okay? And feel free to judge me on this, because everything I've been telling you guys over the years has happened, and I tell you this in advance. It's gonna float that car. All right. 2023, I'm actually, I went on record, or I think I've said here, I actually think, and I'll state this, it is impossible to have a recession when you're adding income into the economy. When this income is rising, I mean, I'm trying to figure out a scenario, especially in the kind of economy we have, which is really a consumption-based economy. You know, if we had an economy like China, which is, production or something, and people were getting income, but they're not building buildings and infrastructure and export goods, I don't know, maybe that would be a different story. But in a consumption-based economy where consumption is, 70% of our GDP, I just can't see a scenario where you're adding income into the economy through these transfers, okay? Interest income transfers, Social Security, these social nets, defense spending, all these things. And I know they're not equally distributed. I understand that. But it all goes into the swimming pool and it gets circulated around. That's what's called the economy. Frankly, I can't see a scenario where you're doing that and you're going to get an economic contraction. I'm saying it's impossible. And look, come back at me, in 3 months, in 6 months, in a year, if we're in a recession, and say, Mike, you really made a big mistake. You don't know what you're talking about. I mean, I'm putting myself out there. And I'm literally saying, I just don't see the possibility of a recession when you're net adding income significant, I might add. I just went over yesterday that Social Security alone is going to add another $100 billion. Look, they're talking about, think about this for a second. The Fed's talking about now, we had the goofball Neil Kashkari, Minnesota Fed president, Minneapolis Fed president, saying like now it's got to go up, the rate's got to go up to 5.5%. 5.5% on 32 trillion in outstanding government debt, securities. You're talking about 1.75, almost 2 trillion annually addition of income. All right? That's like a massive, massive spending bill. And that doesn't even include what the Fed is going to be paying to the banks on interest on reserves. That's going to be another $330 billion interest on reserves. So, I mean, it's crazy because you got to go about this scientifically. You cannot, at least for me, I cannot say, oh, rates are going up and everything's going to crash, because that's like you're leaving out so much of the picture. I can't even, I'm trying to think of an equivalent analogy in science where you would make an assumption, all right, based on one input and just completely ignore other factors. I mean, that would be, even a undergraduate level science student would say that is a completely flawed analysis or experiment. Like, just wrong from the get-go. But yet we allow this to go on. And not just that we allow it, we accept it. I mean, it's broadly accepted. So that's, I just don't see it any other way. I don't see it any other way. Like this is kind of a dogma. It's just a belief system. That's out there, that's universally accepted, but it's completely wrong. It's like, recently, again, what's been popping up. You know what's been popping up recently? I'll tell you. The critics of MMT are out there again with their, MMT has failed. We tried MMT and it has failed. Well, let me tell you something. First of all, MMT didn't fail. And I'll tell you why in a minute. Second of all, MMT is not a policy. It's a description of how the monetary system works. Just like physics is a description of, matter and the universe, biology is a description of how living organisms, are constructed, how they work, how they function, etc. And MMT, to say that MMT failed, it's completely wrong, because there's been volumes of academic publications that totally describe what happened in the situation in the pandemic, where we had massive shortages of supply, and yet lots of income was pumped into the economy. I mean, MMT 1000% explained that. So there was no failure whatsoever. And anyone who understands MMT could say that under those conditions, anyone who understands MMT could predict, or could say under those conditions, you're going to see price increases. And then, those things the price increases were starting to abate, last year. And then the war started in Ukraine, and the United States, went on this massive, and the United States allies, mostly Europe, went on this massive sanctioning campaign, which literally chopped up the global economy into blocks that, it hasn't existed since the Cold War days. And, so it's like, you talk about a disruption. MMT completely predicted or forecasted that, or would have told you that this was going to happen. And by the same token, I've said here on this channel many times that if you believe in capitalism, in other words, the profit motive, and I think most of us do, at least to a certain extent, then you cannot argue against, money printing, whatever you want to call it, because when the government spends, if you're a capitalist, that induces the private sector to produce the goods and services that the government wants to purchase. So the mere creation of money in the pursuit of the government provisioning itself will trigger the capitalist system to produce the goods and services in a quantity that meets the demand. So if you call yourself a capitalist and you argue that the government spending money is inflationary, you just don't understand capitalism. Now, at a level where the economy is unable to produce those goods and services, yeah, you're going to have inflation. But MMT completely describes that. Completely describes that. So these people who critique, it's like this argument that rising rates are bad. Just a blanket statement. They leave out entire aspects of the analysis or the conversation. They just ignore it for, they have an agenda. So they ignore it. And they say that, oh, you see, that's the proof. It's not the proof. It's so far from the proof that it's comical, okay? That it's ridiculous. So anyway, I just wanted to say that. All right, everybody. Have a good one. Don't forget, sign up for a 30-day free trial of MMT Trader. Go to my website, pitbulleconomics.com. See you tomorrow. Bye.